credit insurance companies find themselves in a constantly changing and challenging market environment. So our next panelist on credit insurance in these challenging market conditions. We will give a current state and highlight what the credit insurance industry is. Challenges and opportunities for insurers and MGAs will be highlighted with a special focus on the possibilities of technological support within the underwriting process and especially in credit risk analysis. Lara Biermann, Head of Sales Credit Insurance at SCHUMANN, will moderate this panel. So Lara, the stage is yours.
Thank you, Robert, and a warm welcome to our audience. So today we are speaking about credit insurance in challenging market conditions. And yeah, I'm very lucky to have such a well-staffed and experienced panel with me today. So we have Samuel Fatazade. He's Head of Trade Credit for Germany, Austria, and Switzerland for Nexus. Jesse van Cleef, he's the Head of Multi-Buyer Trade Credit Europe for Liberty. And Michael Holly, founder, CEO of Equinox back in the days, 41 years of experience within the trade credit market, and today a strategic advisor of SCHUMANN. So thank you very much for joining us today. So maybe let's start with an easy question, maybe like as a little introduction for everybody who has never heard of trade credit insurance before. Jesse, could you maybe give us a little introduction on what trade credit insurance actually is?
Yeah, thank you, Lara. Yeah, well, who doesn't know credit insurance, I would say. But yeah, you can explain it in various ways. I will try to do it as simple as possible. And I think credit insurance is about that it covers unpaid bills if your customer is not able to pay. It is business to business. It's obviously about trade on credit. And it usually covers three things. It covers extended payment default, so late payments. It covers insolvency of your buyer, and it covers political risks. And political risk, yeah, you can give several examples. It can be expropriation, it can be currency inconvertibility, it can also be other political events why your customer is not able to pay.
Mm-hmm. Great. So maybe to make it a little bit more easy to understand, Samuel. So if I was working in the trading business, why should I buy trade credit insurance?
I think in essence, there are three main reasons. I mean, the first one obviously is it's cover against default. So if somebody owes you money, if you have outstanding invoices, in the event of an insolvency or any other scenario that has been described, you will get your money. There's a protection. So that's I think the most important one. But obviously there's also information available. Credit insurers review all buyers in your potential portfolio, all of your customers very carefully, and can help you to develop your business with specific customers, can advise you also where you can maybe offer extended terms, where you should focus, maybe even if you plan an expansion in different countries, different industries, so all that information is available. And last but not least, and increasingly important in recent years, I think, is the financing aspect. So I think factoring has also been addressed at some point earlier here at the conference, which is, I think, in Germany at least, you need credit insurance and able to sell your receivables to a factoring company. So it will just help you to strengthen your liquidity.
Okay. So now that we set the foundation, so we're speaking about trade credit insurance in challenging market conditions. So how do you assess the market conditions today? Are there any challenges that each of you is, maneuvering every day?
Well, shall I pick it up? Yeah, many challenges, and I don't think I'm saying anything strange or surprising to the audience if you say that you had, Ukraine, you have the Middle East, you have issues in Asia, you have high inflations, you have a lot of elections in very local circumstances, as well as, obviously America. So there are a lot of things why it is challenging at the moment, and to well, from a balance sheet to look at that and say, okay, is this company going to survive the next 12 months? And yeah, there are many influences from a geopolitical basis until the sector, etc., which can have a huge impact. That actually combined with the fact that the last few years didn't show that much claims, is a challenging environment. And then some new entrants, and so there's a lot of price pressure as well. So definitely challenging, yeah.
To add to that, I think one of the challenges is also that identifying the risks has become increasingly difficult in this environment, because I mean, what we usually do to kind of identify a risk or to determine how much risk there is for insolvency or default of payment is very often looking at balance sheets, or in regular cases looking at balance sheets. They are always in the past, right? So that's a general kind of issue. But in a very stable market condition, you can just rely on those. So if you in 2024 look at the 2023 balance sheet and it looks strong, then you can, with a very high probability, assume 2024 will be fine for that company. What we see though is in recent years that you had several, or you have several impacts that actually changed that. I mean, I don't know. This might be a relatively new one, and then they're not close to insolvency. But Volkswagen, we discussed this earlier as well. I mean, posted really significant profits. I think 22 billion last year, and now they announced large-scale restructuring. In essence, there's other companies as well, like BayWa, also relatively famous in Germany, that found themselves all over sudden, I would say. I mean, probably not that sudden, but for the public it was sudden, with a almost $500 million gap in their financing. And that's just something that's not easily available and predictable from previous financial statements. So I think it's more difficult in this environment to actually identify the weaker risks.
Interesting. So we spoke a lot about the current market conditions, but we have Mike Holly with us. 41 years in trade credit insurance. It's a long time. So maybe, maybe from your perspective, as you've been into the markets for such a long time, are there any things that have changed? Maybe the market conditions, the way you analyze in trade credit insurance. Can you give us a little bit of an insight?
Yeah, you should have said that you were surprised that I don't look old enough to.
Yeah, well, the audience can tell that on their own.
So, I think one of the ongoing problems for the market, if we look at the insurers, the reinsurers, and the brokers together as one group, is that the growth is only a little bit ahead of inflation over the past 15 years or so. On the other hand, the past 15 years have been really favourable in terms of loss ratio and profitability, but it's getting that growth, and you have a what's called a protection gap, where a large number of the potential insureds are not buying, and yet despite the in some ways a favourable record of the industry over the past 15 years, we're not quite somehow reaching those people who are not yet buying. So in a way, there's kind of still money on the table, really, for more people to buy trade credit insurance. And collectively, it would be nice if we could find a way of doing that.
Yeah, maybe we can ask Jesse and Samuel about this. So talking about the market penetration of trade credit insurance, can you give us a little bit of an insight? How much potential is there still?
I think there's quite a lot of potential as well. I mean, Mike, what you're referring to, I guess we also discussed it previously, then is the SME market. So definitely there is potential, but in terms of growth, I think it's the overall market. Yes, it isn't growing that quickly, but this is largely driven by the traditional insurance market, I would say. I mean, I think the experience we have as specialty insurers is a very different one. So where I just think it's also partly because the solutions have been, I mean, obviously they have been modified, they have been improved, but they haven't, the basics are still very much the same. And this, I mean, it's not entirely accurate, but this one approach that's supposed to fit everything clearly doesn't work for the whole market. So I think actually, with a bit of creativity and innovation, there still is plenty of room to grow to actually make solutions that are fitting for companies that are currently not finding their solutions in the existing market.
Yeah, I agree. I think, especially with new technologies and AI, etc., you hope that you would be able to provide better solutions for the SME market. However, it's insurance, and insurance means that people want to know for sure that they will be paid if there's a loss, and that's they would like to see a human. That's I think the challenge, and I think if you look at the upper side of the market where the specialty insurance are there, we are able to provide that service. We are able to provide tailor-made solutions, and I do think there the market is growing, but yeah, the main challenge is actually in making sure that you can provide that service as well to all kinds of companies. And I'm still not sure how to do that. I do think that after COVID, with being able to have Teams calls, etc., it does add value. You don't need to go to your customer 4 times or 6 times a year, but you actually can limit that to 1 time and then see them via Teams or whatever. So I think technology is going into the right direction, but making sure that you still have that people involvement. Yeah, I think that's the big challenge we have.
Interesting. So I'm looking at you, Mike, again, right? So would you like to add something?
Yeah, so if I think about what it was like in 1983 when I started in the industry, I would say that the service that the large customers have is far and away outstandingly much better than it used to be back then, right? No, the pricing is more competitive, the turnaround times are better, the claims performance is better, the flexibility of the market is better, everything is better. But if I look at the SMEs, I think it's probably worse than it was back then. And if you think about export credit insurance, back in 1983, you could only get export credit insurance from the state. And when you were working for the state, as I was at the beginning, we made absolutely no difference between how much time we spent on a policyholder that spent 2,000 euros premium compared to one that spent 2 million euros premium. And the export credit agencies, I'm sure, at that time were losing money administratively in what they provided for the very small exporters, because not because the claims were high, but because you're just spending way more time on it that could be justified. But that was kind of okay. It was seen as okay at that time. Whereas in the progress that's been made in the subsequent years, I feel it's really hard to find a way to justify spending the amount of time you need for the smaller insureds. Now, it's not an even picture across the world. So I think in Germany, the SMEs probably have the best case. And I think what R&V has done in Germany is really spectacular. And it would be nice if every market had an R&V in it that was really able to get that type of growth and supply the SME market. But yeah, in a lot of the other countries, there is nothing quite like that there. The big insurers really try very hard to do it, but it's difficult when you have to cover all segments of the market. So it's still a challenge for us really to. If we could make every country like Germany, that would be good, actually.
What great advertisement. Thank you. So actually speaking about the amount of competitors in the market, so what we see is a lot of MGAs entering the market, right? So how do you feel about that? Is that growing the market? Is that a chance for growth? Is it more like painful for you as you face more competition? Or like, can you give us a little bit of an insight into how you feel about that? Maybe Samuel, maybe you start.
Yeah, I mean, obviously, I work for an MGA myself, and I really think MGAs add a lot of value to the market because this is where the innovation comes from. I started my career working for Mike Holly quite a while ago at back then Equinox, who was an MGA that entered the market, and the offering that came with it, the non-cancelable credit limits, I mean, also I think, relatively easy wordings that left a lot of freedom to the insured. It was a lot about understanding the insured and also trusting the insured, and not so much about regulating every tiny piece of what they do and don't. And similarly, top up also, that I think has been now become a very important aspect of credit insurance. And I think this is driven by the MGA market, because it's much more difficult for a very large, well-established insurer with all their processes, all their system. Everybody has been doing things in a certain way for a very long time to actually come up with this. And it's not just difficult, but they don't really have the incentive, because things are going well, right? I mean, obviously growth could be more, but it's profitable. It works. So I think if we really, for the market as such, MGAs are really, really valuable in my view. And obviously new entrants, yeah, well, there's more competition, but then again, it really brings a new dynamic. And if the market as a whole grows and more people, I don't know, are helped and served by the credit insurance market, I think that's good for all of us. That's my take.
Yeah, I absolutely agree. First of all, actually, it's not only MGAs entering the market, but also just bigger credit insurance companies. Yes, I do think it's growing the market. There's innovation. There's also risk to it, to be honest, because what I think is not good for the market is that companies enter the market, go in big, have a lot of publicity, and then withdraw again, because that unrest in the market actually is not helping customers. So there's a risk to that. However, assuming that they will be there to stay, then actually it does add value, and then indeed you, by competition, you get better products, better service, and etc. And I think so far it also is actually increasing the pie. So there's been a lot of discussion about how can we make sure that more credit insurance is being sold, so that more customers know what the product is, and that they see the benefit of it. And I think that is working. I think with all these new companies, it is actually adding value, and the pie is increasing.
Absolutely.
So in that sense, yes, it works.
And also to add to that, I mean, you said earlier, Mike, that the service was much better for the large clients, and on a service perspective, that's certainly true. But I think one of the things that you also see is that actually it seems like some very large corporates have more or less outgrown the credit insurance market. So one individual credit insurer is not able to serve the needs of a very large insured.
So it's about collaboration.
It's
as
about
well.
collaboration. I think this is really also where the MGA market helped, because historically this always has been a big challenge. We know the market is more or less dominated by the so-called big three, right? They're opening up, they're working together more and more, but historically they never wanted their competitor in the relationship, right? And now we see a lot of solutions. I mean, we are also, as Nexus, we are part of solutions where they have 2, 3, 4 insurers that pick up different aspects of the risk, but also structurally work together really well. So it's well, obviously it's more complex to have several insurers. Still, the way this is structured at the moment and developing is relatively easy, and I think really helps also the big clients.
Absolutely. Yeah, no, that's if you look at last year, for instance, yeah, you have seen increased usage of co-insurance and especially syndication, where in the past it was usually focused only on London, and nowadays actually you also see that in continental Europe and other places as well. So you do see that indeed companies who didn't get the capacity in the past are getting it, and hence get a solution. Yeah.
So actually, I'm looking at you again, Mike. You've done it. You founded the MGA, 41 years in the market. Like, did you have the feeling when you founded Equinox that you somehow also had a change to the chance to change the market, maybe a little bit for better?
Yeah, that was a prime driver actually. And if you look at the market today, in terms of certainty of cover, in terms of cooperation between insurers, in terms of top up, it's improved everywhere. And what's particularly good, I think, is that the large 3 monoline insurers are also participating in syndication and top up. They also participate in non-cancelable limits. They give greater certainty of cover. They give grace periods as well. They also um, all of those changes are within the big three and therefore across the market. So I think everybody benefits from that. I guess the word of caution would be that when you're coming with a new MGA, it is beneficial really if each new MGA is bringing some new idea to the market. And I would be a little bit concerned that the easy space to go in is to do a startup on MGA, and yes, you offer top up and non-cancelable limits and so on, but it would be nice as well. We need MGAs to come with new ideas. Some of them are actually, but we need to continue bringing the new ideas that stretch the market a little bit further and improve it for everybody.
Yeah. So don't copy the others. Find your own unique selling point.
Yeah, and for example, something targeting SMEs would be nice. I'd love to see that.
So that's a call into the audience. Feel free to launch it. We're happy to see that in the future. But we talked a lot about collaborations, low claims, low amount of claims, good loss ratios. Why aren't you signing for bigger risks? Maybe risks that you haven't signed up for in the past. Like we talked about co-surety. Wouldn't that be like a great opportunity to, come together, sign the heavier risks? I see you both smiling, so it's a good question.
Yes. No, please start. I will.
So I think, in my perspective, the low claims ratio, for instance, in the last few years, I'm not sure how to best describe it, but in a way it has been, this is not the perfect expression, but it has been a lucky coincidence. I mean, obviously in 2020, in March, April, May, whatever, we didn't expect to have a record low claims ratio in 2020, 21, right, and maybe 2022. So the issue is, obviously in hindsight, things are very easy. Picking risks is very easy in hindsight. So I'm personally would argue that the industry hasn't been too risk averse. Just because something happens or doesn't happen doesn't tell you anything about the probability it had at the time of making the decision, if that makes any sense.
Yeah.
So I think that this approach, and this is exactly what credit insurance I think should do, is stable. So what we are doing, I mean, the credit insurance in a way picks up the risk that the insureds have with the market, right? And this volatility is what credit insurance is for, so the clients don't have to experience it. And sometimes in times of uncertainty, things go very well, like they have done. And sometimes in times of uncertainty, things don't go that well. And then the claims ratios of the insurers will also look very different. So, and I think it's again, if we as credit insurers went too much into the cycle, or we had a decent claims ratio, let's be very aggressive on high risks, and then we have a very high claims ratio, and then we are very restrictive. I mean, to some extent you can observe that, right? But we really need to make sure that this doesn't get into the extremes, because I think the credit insurance has a purpose of stabilizing the market, be a stabilizing force, and not go with every up and down and every trend. Not sure if you share that view.
Yeah, absolutely. Actually, I was thinking about the same, and I already mentioned that it's very important that it's a stable market. We were supposed to be a bit boring, so you have a certain underwriting strategy, and if you suddenly step away from it, that can, on the short term, be very nice, but on the long term, it can be very disturbing, because suddenly, if things go wrong, you start to panic and you start to take measures and doing the opposite. Well, I think the market is benefiting most if you have a stable approach and look at how you can do things rather than just ride the waves. And I do think that if you look at things from a holistic view and try to see what you are able to do by tailoring the policy wording, by actually making sure that the customer is willing to take some retention, by making sure that you have a full picture of the whole plan, then you might be able to do something for that customer. The question, though, is that, well, are you able to do that for an SME? It's difficult. But for the bigger customers, that's definitely possible. And I do think there are opportunities there where you can still do good business if you look at from a bigger picture than only that particular very difficult risk.
Okay. So, I mean, it's a credit risk conference, right? So it's part of your daily life. You already mentioned, analytics are, toughest part for your job. Speaking about technology in use within the trade credit business, how do you feel the current state is? Like, or would you even think that, yeah, a higher demand, a higher usage of technology would lead to market growth as well? Yes, so you're already smiling at me. What's your
Oh yeah, no, I think the answer is yes, of course. And I think we're not there yet. I think everybody is playing around. Well, obviously using a lot of techniques and automation. AI is the big buzzword, and everybody is well doing something with it. But it's just a start. So I think probably 10 years from now we'll look back and say, okay, that was the start of something new. In a way, I also hope that, because that would mean that we would grow the market. But at the moment, we are not there yet, and that's also, I think, where we stand. It's quite hard to make proper underwriting views based on the current knowledge and then predict whether a company will exist in the next 12 months.
Yeah, I think you want to reduce the unnecessary claims, right? So when you look at the claims coming in, some of them you kind of think, well, that's okay, that was inevitable, that was going to happen. Some of them you think, if somehow we could have spotted that. And the problem with unnecessary claims is that increases the price for everybody. As the price is increased for everybody, then less people can afford to buy the product and penetration is lower. So you want to get rid of those unnecessary claims. And technology really helps to do that. So for example, in fraud detection, technology can help to the market to avoid those cases of fraud either by the insured or the buyer. In terms of where people are setting limits by discretionary limit, for example, sometimes more technology would help them to avoid stupid mistakes which end up with more claims being paid. And then just better risk assessment generally is going to also help in the advance warning. So just on that part, the risk assessment part, technology will continue to improve the payment of unnecessary claims in the coming 10 years.
And much less glamorous, but I also think like technology in every industry, and but also obviously in the insurance industry, just helps to reduce cost, which then will benefit everyone, because there's still, I think, every company, this is not limited to insurance, I guess, still has a lot of manual processes. People just entering data, for instance. And I mean, sometimes if you think about how often a certain data point is entered by different people manual in a given process. I mean, and again, that's very general, but those type of things, obviously, they will just reduce the overall cost, which should make things more attractive and lead also probably to lower prices, make it more attractive for insureds.
Yeah, or better conversations with the insured.
Yeah.
So they get that service and you are better able to understand what they need and fill their gaps.
Yeah, have people focus, because I think one of the things that's going to be difficult, I think some people, maybe also in the SME, really hope that it can be standardized and automated to very large extent. And I think things can be automated, but still the product is, I really also feel in my experience that people actually want to talk to an underwriter, because we talk SME, but if you run a business, an SME business, and it's your business, and the credit insurer, for instance, says, okay, well, we will not support business with this client. Might be a very important client for you, but we will not support it. This obviously makes this business owner nervous. And then he wants to have somebody to discuss this with. He doesn't need a 0 on a screen with then a I don't know, some generic reason like this is based on confidential information. Congratulations, right? They want to talk to somebody. So I think, this is where this could add in, that we maybe reduce the manual work where we don't need it, and have people for that, because I'm not sure if that's going to go away. Maybe chatbots in 10 years can do that, but I'm not convinced.
Yeah.
Well, let's hope I'm right with the 10 years view. Might be longer, but it's of course from an insurance point of view avoiding these unnecessary losses. But it's especially what you mentioned. The other hand is that you actually make sure that the insured gets the best cover. While sometimes because of lack of information or lack of ability to do proper underwriting, you have to say no now to a certain risk. While if you would have the time and the proper tools, you might be able to say yes.
So let me actually jump in here, because we got a question from the audience actually. So it's about the buzzword API. So somebody in the audience asked to what extent APIs to brokers and clients are important in the future to grow the market.
I think my personal view is that they're very important. I think this is something where maybe the industry is also behind, because it's not like it's the next big thing, right? It is the thing from 5 years ago to 10 years ago. It's necessary, because it's exactly one of the things. People logging onto systems, putting in the exact same information in their system and another system, and then if they have another insurer, maybe they put it in 3 systems. They just need to make sure that the names and amounts and dates in 3 systems match, and that's what somebody has to do manually, and it takes up a lot of time. There's room for error. So yeah, most certainly this needs to be used much more. I think it is already used quite a lot, but much more, because this is the I guess the most unnecessary step of all, is kind of triple entry of the same data in 3 systems.
Yeah, we're quite good at not having triple entry of credit limit applications, but policy applications, proposal forms, we're not so good. We're still not there.
Okay, maybe another interesting questions out of the audience. So we're seeing currently many MGA startups in the market. Why is that if the market isn't growing as fast as other insurance markets?
I think there's still room to grow. So I think that's one reason. I think MGAs, and again, wider insurance companies, are seeing opportunities to provide something where they think the market is not fully mature yet. So and I also think that the market in itself is growing. So I think that pie is increasing. Perhaps not as fast as we would like to see all, but I think there is a market for everyone, and I think that's just simply the reason.
I would say it's an effect of the improved technology we already have. So that the entrance barrier was absolutely phenomenal 20 years ago, 30 years ago. And if you wanted to build the technology to do credit insurance, it would be almost out of reach unless you were the government. And now, because of companies like SCHUMANN, the entrance barrier is much, much, much lower. And it's therefore natural that the thing that was stopping more participants coming into the market is taken away. So we shouldn't be surprised that more participants enter now that they can. And that's one of the main benefits of technology, actually, is that it enables that diversification of supply.
There's another aspect I would also argue is that actually now it's a more established model, because I think this is something that the insurance reinsurance world, I think they're always a bit they're looking carefully if a new MGA comes around, because obviously it needs to be managed very carefully, and I think not everywhere in the reinsurance market MGAs have a really strong reputation, but now we have very well established MGAs. If you look at Equinox now Nexus, I mean, in the market for more than a decade, in the UK 25 years. So there is a track record of MGAs really working, right, and not just being there for the short term underwriting, aggressive, high risk, taking the premium and then leaving the market 2 years later. So I think this is also partly why.
Okay. Thank you very much. I'm looking at the time, so I have 1.5 minutes left. Maybe like as a little conclusion, when you like have to look into the future, maybe one buzzword or maybe just a couple of words around it. What's the most challenging risk that you see for the future for the trade credit market? What's from your personal opinion, maybe?
Shall I start off?
Yeah.
So
Yeah.
it's 16 years since we had a real trauma in this market, and the people who were the decision makers then, a lot of them are not still around. So it is a little bit of a worry that 16 years is so long, and you forget how well will we survive the next onslaught, which will come.
Interesting. Yes, sir.
Yeah, I was about to say the same. It's geopolitics.
Okay.
Like I started actually with a long list of what's currently happening, and well, that might be a start. So that's the main
political
worry.
risks, a lot of elections coming up, so
Yeah.
interesting times. And Samuel?
I really think it's the biggest risk for the market as a whole is that we don't manage to again cooperate better and more to really stay relevant and ensure that we not occupy ourselves too much with ourselves, but continue to provide solutions that actually are necessary and required.
Amazing. So, on point, Robert, I'm handing back to you. Thanks everyone for listening. Thank you for participating
Thank you.
and for the interesting insights.